Hi, I'm Wyatt.
And I'm Grace.
And you're listening to our dad and your host of the Vacation Rental Revolution podcast.
What's up, guys? Welcome to another episode of the Vodacy Vacation Rental Revolution podcast. I'm your host, Shawn Moore, and thank you for joining me for our today's Tuesday's tips. These are short, quick episodes where we answer one question that gets emailed in. Sometimes they're common questions that we hear on a regular basis, but this one's really pertinent to the markets and where we're at right now. And Jeff sent in a question that says, hey, Shawn, what's causing the ongoing home price increases even with inflation and interest rates skyrocketing right now? And so, Jeff, it's a great question and one that's on a lot of people's minds. In fact, there's a lot of people that are saying, hey, I think we're in a bubble. We've got all these things going on. Everybody's talking about a recession. Everybody's talking about inflation. Everybody's talking about interest rates going up. And so I'm going to wait till prices come down. And I have been saying for a little while now that I don't think that's going to happen. And Jeff, I'm going to answer why I don't think that's going to happen anytime soon. And it really comes down to what I've been talking about for a long time is fundamentally we have two forces in action the gap is pretty wide between supply and demand on the housing front. We are way behind the 8-ball, and we've been behind the 8-ball now for 14 years. We have, I pulled some information up, and we have 14 straight years below the 50-year average for single-family home properties coming on the market being built. So single-family housing units being completed in a given year. So what that does and what that means is what happened is in 2008 when we had our last the real estate bubble burst, right? And our last, major recession, the Great Recession in 2008. And it was really fundamentally caused by the real estate markets. We had a way oversupply of homes and ended up demand dropped and prices dropped. And when that happened, a lot of contractors, a lot of home builders, a lot of subcontractors in the housing business construction trades, they went out of business. And as those markets continued to slide, and then all of a sudden demand started to come back in about 2011, 12, and nobody was building homes, and so demand kept going up, and home builders were not able to catch up, and we had this gap that started to widen. Well, it's been widening now for 14 years. And so we have the real housing crisis that we have right now is because we have a shortage of supply and increased demand. And that increased demand is not going away and has not gone away, even with the spike in interest rates. Has it curbed a little bit? Yeah, but with the spike in interest rates, we've actually seen that gap start to widen again and actually add fuel to the fire of what the real crisis is, and that's that inventory levels being so low and where there's no houses on the market. And so what happens is, think of yourself if you're a homeowner right now and you're thinking about upgrading into a new home. Well, let's say you have refinanced the last couple of years and you've got a 3.5% home mortgage and you're paying all of a sudden you're saying, I might upgrade, but now I'm going to look to upgrade and house prices have gone up. Even though my house price has gone up, okay, that might be a wash, right? I'm going to get some nice equity and I'm going to sell for high, but I'm going to buy at a higher price. But my cost to own that home has gone up significantly because as soon as I sell that home at 3.5% interest rate that I have on my mortgage, I'm gonna have to replace it with 5.5%, 6% interest rate, maybe higher, depending on where you're at and what your situation is. Now all of a sudden that cost to own that upgraded home is pretty significant. So we have sellers that would normally be upgrading saying, I'm not gonna upgrade right now and I'm not gonna put a house on the market. So we actually don't have a lot of resellers putting houses back on the market. So we're adding fuel to that fire of the low inventory and the low supply in most of these markets. On top of that, our demand is not going away for a couple reasons. One, the biggest buyer pool for home buyers is typically in that age range from about 25 to about 35, 40 years old. Well, that happens to be a huge segment of the population called millennials, right? We all talk about millennials. It's kind of like when baby boomers came through markets. Entire industries, entire markets were built on baby boomers. We see the same thing with millennials. Well, millennials are now in this home buying age range, and they're there's a huge demand for millennials to buy properties, and they're going to. They're going to say, hey, listen, we're not going to put our lives on hold. We're going to continue to move forward. We're going to still do what we have to do. I remember when I bought my first house, it was a 10% interest. It doesn't stop you from saying, okay, I'm going to buy a house, right? Some millennials and some people are priced out of the markets, and their buying power is less than it might have been a year ago because rates are up, but they're still going to buy a house, right? They still want that dream of home ownership. And so we've got a lot of demand just from one segment. And now on top of that, you have a lot of demand from a lot of people, myself included, that are saying, hey, listen, I want to buy and own as much real estate or hard assets as possible. Real estate is a preferred asset class when it comes to a tangible asset to help hedge against this crazy inflation we have going on, right? We have you're close to 10% inflation in the US right now. So I'm better off buying a tangible asset that is going to go up with inflation versus save that money and put it under the mattress or put it in the bank and let it go down in value every single year. So you've got a lot of people that are saying, hey, listen, I want to park my money as a hedge against inflation into real estate. Real estate is one of those really great asset classes that's very preferred for a number of different reasons that we just talked about. But also on top of that, you've got leverage with real estate. I can go buy a $500,000 property with 20% down, put $100,000 down. If that property goes up with inflation by 10%, next year that property is worth $550,000. Well, I only have $100,000, so my $100,000, instead of going in the bank and being worth $90,000 or my buying power going down to $90,000, my buying power actually went up, and I hedged against inflation because I owned an asset that went up, and I just gained $50,000 on my $100,000 investment. Really simple math right there that a lot of people don't quite understand, and saying, even with high interest rates, when you run the numbers, a lot of times you're much better off to put your money into a tangible hard asset, especially if you understand it. Now, you want to make sure that it pays for itself. You want to make sure you're not over leveraging, and you want to make sure you're not putting yourself in a position that you shouldn't be putting yourself into. It's not what this episode's about. The question is, why do we continue to see house prices go up? Well, we have a supply and demand gap that is really wide right now. And across the board, we're seeing that, even though things are softening and things are slowing down a little bit, Redfin put out a report last week at the end of, or a couple weeks ago, it was at the end of the second quarter, end of June, and it was showing where the housing market's at year over year and the softening in the market. Well, the softening was almost insignificant. It was crazy because what we saw is, even though the time on the market has increased a bit, that inventory levels started to increase a bit, and now we're actually starting to see them go back the opposite direction. The average, a neutral market for as far as supply and demand goes, is about 6 months of inventory. What that means is, if you have, in any given market, if you have 10 homes sell in a market, 6 months of inventory would mean that you'd have 60 homes on the market for those 10 buyers to look at. That would be considered a neutral market. Right now, in the U.S., as an average across the board in the U.S. Now, keep in mind, every real estate is very regional. Some areas are going to be less than this, some areas may be a little bit more than this, but on average, we're only at 2 months of inventory. So for those 10 buyers that are buying homes this month, there's only 20 homes for them to choose from. That's very much weighted still as a seller's market. Now, are we seeing 50, 60 offers and everything selling way over ask price? Some markets we still are, but we're seeing it come down. But does it really matter whether you're competing against 30 or 40 or 50 people versus competing with 5 or 10? Or a property that sold in 24 hours versus a property that sells in 3 or 4 days? That's still a crazy hot market, and that's why you're still seeing prices go up even in this environment. And we've been talking about this for a long time. Inventory levels do not catch up overnight, and there's got to be a reason for them to catch up. There's not a bunch of people that are just going to be selling their houses. You hear people saying, well, there's all these people, there's going to be a flood of foreclosures, there's all these people in default. Well, that might help our inventory levels to the point where those people might decide to sell. But why in the heck would anybody foreclose on a home? The majority of homeowners right now have equity in their homes. And so they haven't been able to over leverage them for the last, since the crash. So for the last decade, we haven't been over leveraging homes for the most part. We're seeing people having to put money down. We've seen crazy appreciation. So if I'm behind on my payments and I can't make my payment and I have a mortgage of $400,000 and my house is worth $6,000, why the heck would I foreclose on it? I'm not going to foreclose. Doesn't matter what everybody tells you on paper. I might be in default. I might be going into foreclosure, but why the heck wouldn't I sell it and take my $200,000 of equity? That is what you're going to see happen. And it might have some people that will put houses on the market. But man, it's a gap that is so wide. And in my opinion, the real housing crisis and what we need to recover from, because I believe we need to build ourselves out of this. I believe that is one of the only solutions, is we've got to be able to build more homes in a more efficient way that can keep up with demand. But when you look at the reports, we've been behind every single year for 14 years. So that gap continues to widen and widen and widen until that gap starts to narrow. We're going to probably see houses continue to appreciate. And so if you're investing, if you're buying, sitting there waiting for prices to drop, you might be waiting a long time. Now, I don't have a crystal ball, but Jeff, that's the answer. And what I've been watching for the last few years now and been talking about. Go listen to my podcast for the last 2 or 3 years. We've been talking about this. And rising interest rates, though they curb demand a little bit, they didn't solve anything with the inventory issue. And so while demand curbed a bit, it didn't curb that much, because we also have an asset class in real estate that a lot of people want to hedge against the inflation going on. So you got that issue, people saying, hey, I'm still willing to buy. You also have a huge segment of the market in those home buying stage of life, and those buying years between 25 and 35, 40 years old, called millennials. They're buying houses. And so demand is not really curbing that much, which is why you're going to probably continue to see prices go up. So Jeff, thanks for sending in that question. We will wrap it up for today. And as always, thank you for joining me. I know your time is valuable. We try to make sure that you get something out of these shows. If you did, do us a favor. Share this show, like it, give us a review on YouTube and our podcast channels. If you know somebody that could use, that would get value out of this, we really appreciate you sharing it and spreading the word. It helps our show grow and continues to allow us to spread this message and help people as they dive into the game of real estate, specifically vacation rental investing. And as always, guys, my last message to you every single episode is go do one thing that you can take action on to start building that life that you don't want to take a vacation from. Cheers, my friends.
Thanks for joining us on this episode of the Vacation Rental Revolution podcast. Share this with other people you think need to hear about it. And don't forget to subscribe and leave us a review. Hey Grace, is there a website? Yes! For more amazing content and expert advice, visit Vodacy.com. Thanks for listening, and we'll see you on the next episode.